As an individual or a business organization that understands its transactions and is able to identify the appropriate items or ledgers. Now, being able to record those transactions in the appropriate ledgers mean that those ledgers have balances. How often do you check or assess or test those ledger balances? That will take us to trial balance and double entry. Trial balance is a list or schedule of all balances identified after preparing the ledger for a period. Now, let me quickly explain or take us back to our double entry application for assets, for liabilities, for expenses, and for income. We were able to establish the procedures of identifying ledgers from transactions. Now, after identifying those ledgers and posting those transactions to the respective ledgers, those ledgers usually will carry balances, and there's a need to test or check the accuracy of those balances. The list or schedule that is used to test the arithmetical accuracy of those ledger balances is what we refer to as trial balance. The trial balance has a debit and a credit with description. In a very simple form, it lists the ledgers with debit balances in the debit side and also lists the ledgers with credit balances in the credit side. How the trial balance looks like. Now, this is a simple presentation of how the trial balance looks like. It has a column for items of description, the debit, the credit. All ledger balances with a debit balance appears here in the debit side, and all ledger balances with credit balance appears here in the credit side. And at the end, it is expected to have the debit total here to be equal to the creditor total. Preparing the trial balance takes two forms. The first form is by ledger balancing, and the second form is by totals. I already said that preparing the trial balance takes two forms, by ledger balancing or by what? Total. Now, by ledger balancing, we are trying to pass the information that ledgers are prepared from various transactions, balanced up, and then the identified balances used for extracting a trial balance. In a simple form, what I am trying to say is that in our transactions, we should be able to identify items that are assets, items that are liabilities, items that are incomes, items that are what? Expenses. And then post the transactions in their various what? Ledgers. After posting to the various ledgers, we balance up the ledgers and then identify the balances in the ledgers and then use the balances identified to extract a trial balance. Now, in preparing the trial balance by ledger balancing, we must recall our previous classes on what? double entry application for assets, liabilities, incomes, and what? Expenses. I already told you that in the transaction ledger items, we can either identify what? Assets, which has examples can be cash, bank, debtors, vehicles, land, equipments, all other assets. We can also identify liability items, loans, creditors, unpaid taxes, and so on. We can also identify expense items. And then we can also identify what? Income items. I already told you that what? Those items, whether assets, liabilities, expense, or income, behaves in a particular way. They either increase in value or decrease in value. Recall that I already told you that assets, when they increase, with debit, and when they decrease, with what? Credit. Liabilities, when they increase, with credit, when they decrease, with debit. Expense, when they increase, with debit, when they decrease, with credit. Incomes, when they increase, with credit, and when they decrease, with what? Debit. Now, the objective generally is to what? Identify ledger balances after recording what? Related transaction for the period. After posting all transactions to the ledgers, we must be able to balance up the ledgers and identify what? The balances that each ledger is carrying. This is what we will use to prepare what? The trial balance. Here we have an illustration of preparing a trial balance by ledger balancing. So here we have the following transactions were extracted from the books of Fraggle Enterprises for the month of March 2020. 1st of March, started business with cash in the bank, 1,300,000. 2nd of March, started business with cash at hand, 850,000. 3rd of March, purchased goods paying in check, 350,000. 5th of March, sold goods for cash, 520,000. 8th of March, sold goods on credit to Clinton, 356,000. 13th of March, paid for wages and salaries in cash, 280,000. 22nd of March, purchased goods on credit from Mrs. Caleb, 454,000. Now, these are the transactions, and we are expected to identify the items in this transaction, whether assets, liabilities, income, or what? Expense. Now, after identifying those items, we are expected to what? Prepare or open individual ledgers for the items what? Identified. So we are going to what? Apply our understanding of what? Double entry for assets, liabilities, income, and what? Expense. Let's go. Remember, I said when your what? Assets increases, they are debited. When your asset decreases, they are credited. When your liabilities increases, they are credited. When they decrease, they are debited. When your income increases, they are credited. When they decrease, they are debited. And when your expenses increase, they are debited. And when they decrease, they are credited. Now, having understand that summary, we should be able to what? Quickly what? Solve this question. We already have classes on double entry application for assets, liabilities, income, and expense. You can go back to that class to quickly what? Understand the approach. So let's go. The first one here said, 1st of March, started business with cash in bank. Remember, I told you that when you start a business, we refer to it as what? As capital. So there are two items identified here. Capital and what? Cash. Cash here is cash at what? Bank. So we have two accounts identified in this transaction, capital and what? Cash at what? Bank. Cash at bank is an asset. Capital is a liability. Remember we said what liabilities are those what are owings or borrowings, or debts that a business owes others. Now, as a business, if someone is putting the business is what? Owing that what? Proprietor, or is owing that what? Investor. So as such, capital is always seen as what? A liability. So here, capital is a liability, and liability is what? Increasing. So what do? You credit capital. So here we have capital account. 1st of March. Description here says bank, because the money is paid into bank. Remember, capital is a liability, it is increasing. So what do? We credit. That's the first entry. Double entry says every credit entry must have a corresponding debit entry. Now that we have credited capital, we must debit what? Bank. So we have our bank account here. Remember, bank is an asset. It's increasing. So what do? We debit. So we say 1st of March. Capital 1,300,000. Now that we have debited bank and credited capital, that is the application of what? Double entry for that first transaction. So we'll go to the next transaction. 2nd of March. Started business with cash at hand. So we have two capitals here. One, money paid in the bank. The other one, we have cash in the office. So we've already done the one that went to the bank. Now we are having capital again and cash at what? Hand. Two items. Capital is a liability, is increasing. That's a credit. Cash is an asset, increasing. That is what? A debit. So let's go to capital here. We have capital account here. That is what? 2nd of March. We have cash of how much? 850,000. We're crediting capital. That's it. 850,000 on the credit side. That's the first entry. Remember, every credit entry must have a corresponding debit entry. So we are going to open cash. Here is cash account. Cash account here, we have 2nd of March. Capital, cash is debited. 850,000. So that is it for what? That transaction. The next transaction says what? 3rd of March. Purchased goods paying in check. We have two items, purchases and check. And where does check go? Check goes to where? The bank. So bank here is an asset, purchases here is an expense. Remember the rule. When your expense is increasing, you debit. When it's decreasing, you credit. So here, purchases an expense that is increasing. So we debit purchases. Bank here, the money in the bank is decreasing. So we credit bank, being an asset. So let's open purchases here. So we have purchases here. Here's purchases account. We're debiting purchases. So we say 3rd March, bank. Remember, we bought by check. So we have purchases debited here, 350,000. That's the first entry. The second entry now will be where? Bank. So we have 3rd of March, we have purchases, credit 350,000. That's a double entry application for that transaction. I've always said it. Every debit entry must have a corresponding credit entry, or every credit entry must have a corresponding debit entry. So in every transaction, you must make two entries. So the next one here, we have 5th of March. sold goods for cash. So we have two items here, sales and cash. Sales is an income, cash is an asset. What's the rule for sales when it is increasing? You credit. Sales is increasing here because you sold, so it will increase, you credit. Cash is an asset. When you sell, you receive cash. Cash is also increasing, so you debit as an asset. So let's open sales. We have sales account here. So we'll say 5th March cash, 520,000. We're crediting sales because it's increasing by that value. So we have credited sales, so we need a corresponding entry. That will be where cash. So we have cash account here. So we'll say 5th March sales. We're debiting cash. Cash is an asset. It's increasing by the value of sales made. That we're debiting 520,000. So those are the two entries for that transaction. The next one here, 8th of March, said sold goods on credit to Clinton, 356,000. There are two items here. We have sales and Clinton. Remember, when you sell on credit to what? An individual or an organization, that individual or that organization is what? Is a creditor. And creditors are what? Liabilities. Sales here is an income. Remember the rule, when sales increase, you credit. When it decrease, you debit. When liability increase, you credit. When it decrease, you debit. So here, sales is increasing. So let's open our sales. We have our sales here. 8th of March, we have Clinton. You credit sales. 356,000. Now, Clinton here is what? Is a debtor. I beg your pardon, because we sold on credit to Clinton. Clinton is a debtor. Remember, when you sell on credit to someone, that person is owing the business. So you don't call them creditors, you call them what? Debtors. Remember? So as a debtor, is an asset. And when asset increase, what do? You debit. When it decrease, what do? You credit. So Clinton here is a debtor. So Clinton is an asset. So let's open Clinton account here. We have Clinton here. Clinton here, we have 8th of March. Sales, we're debiting 356,000. Why? Because Clinton is a debtor. We sold to Clinton on credit. So Clinton is owing the business. And when you're owing the business, is an asset. An asset here is increasing. Clinton wasn't owing us. That's 0. We sold to him 356. The increase from 0 to 356,000. That's what? An increase in assets. So you debit Clinton here. Now we have done. So we have credited sales and debited what? Clinton. So those are the two entries for that transaction. So the next one, we have 13th of March, paid for wages and salaries in cash. We have two items here, wages and salaries and what? Cash. Wages and salaries here are expenses. Cash is an asset. Remember I said when your expense increase, you debit. When it decrease, you what? Credit. When asset increase, you debit. When it decrease, you what? You credit. So we have two accounts here, wages and salaries. So we have our wages account here. Here's the wages account. So that's on the 13th of March. Cash, we're paying it in cash. We're debiting wages here 280,000, being what? An expense. So it's increasing. So we're debiting. So the corresponding entry will go to where? Cash. So we have cash here, 13th of what? March. We have wages, 280,000. So the next one here, 22nd of March, purchased goods on credit from Mrs. Caleb. Now we are buying on credit. So it means we are owing that person. So that person now is what? A creditor. So that's a liability. Remember. So a liability can either increase or decrease. When it increases, you credit. When it decreases, you debit. We have purchases as an expense. When it increases, you debit. When it decreases, you what? Credit. So we have two accounts here. Purchases and what? Mrs. Caleb. Mrs. Caleb here is a creditor. So let's open the account. We have purchases here. That's 22nd of March. We have Mrs. Caleb. Okay, we purchased 454,000. So we're debiting our purchase. There being an expense increasing with debit. So we have Mrs. Caleb here. 8th of March, 22nd of March, beg your pardon. Purchases, credit here is what? 454,000. So we've credited Mrs. Caleb, and then we have what? Debited what? Our what? Purchases. So those are the two entries, purchases and Mrs. Caleb. Now that we have entered all the transactions in their respective what ledgers, we have to now what? Balance up individual ledgers, identify the balances, and then use the balances to extract our what? Trial balance. So let's balance up capital. Now look at the capital here. We had two entries, 1st of March, 2nd of March, bank and cash. So we have two entries, 1,300,000 and 850,000. So the credit side is higher than the debit side by what? 2,150,000. That's what you have here as what? Balance carried down. 31st March. Balance carried down 2,150,000. So this balance carried down enables you to what? Enables you what? To make the total in the debit side to be equal to the total in the what? Credit side. So the balance carried down becomes what? The balance brought down. So if your balance carried down is in the debit side, it becomes a balance brought down in the credit side. As you can see, at the 1st March, balance carried down 2,150,000. 1st April, balance brought down 2,150,000. The balance carried down is in the credit side here because the credit side is higher than the debit side. So the balance carried down becomes the balance brought down in the credit side. It is the balance brought down that we will transfer to the trial balance. So if your balance brought down is in the credit side, that ledger is said to have a credit balance. If your balance brought down is in the debit side, that ledger is said to have a debit balance. So by this ledger, capital account ledger here, our balance brought down is in the credit side. This capital account is said to have a credit balance. So now let's balance up what the purchases account. If you look at the purchase account, there are two items here, 3rd and 22nd, bank and Miss Caleb. We have 350,000 and 450,000. So the debit side is higher than the credit side by 804,000. That is the balance carried down you're having here on 31st of March, 804,000. So this balance carried down becomes what? Balance brought down of 804,000 in the debit side. So this purchases account is said to have what? A debit balance. Now look at your bank account. Your bank account here, we have two items as well. We have debit side having 1.3 million, credit side having 350,000. So the difference between the debit and the credit is 950,000. That is the word balance carried down you have here. The balance carried down becomes the balance brought down of debit here. So that means the bank account or the bank ledger has a debit balance. The next one here is cash account. Now the cash account, we have three items. We have 850,000 on the debit side, 520,000 on the debit side, and we have 280,000 in the credit side. So the debit side is higher than the credit side by 1,090,000. That is the balance carried down you're having here. So this balance carried down becomes the balance brought down. So this cash account has a debit balance. The next one, we have Mrs. Caleb's ledger. So let's balance up. There's just one item here, which is what purchases. We have 454,000 in the credit side. So the credit side is higher than the debit side by 454,000. That's the balance carried down you're having here. So this balance carried down becomes balance brought down here. Remember I told you, if your balance carried down is in your debit side, it becomes a balance brought down in the credit side. So by virtue of that, Mrs. Caleb's account has what? A credit balance. So now we have sales account. There are two items in the sales account here, cash and Clinton. So we have 520,000, 356,000. So the credit side is higher than the debit side by 876,000, which is the balance carried down you're seeing here. The balance carried down becomes the balance brought down in the credit side. By virtue of that, the sales account has a credit balance. The next one is Clinton's account. As you can see, Clinton's account here, one item here in the debit side, 356,000. 356,000 is higher. That's the debit side. It's higher than the credit side by 356,000. That's the balance carried down you're seeing here. So this balance carried down becomes balance brought down in the debit side. So by virtue of that, Clinton's account has a debit balance of 356,000. The next one you have here is what? Wages. Wages here has one item, 280,000 on the debit side. So the debit side is higher than the credit side by 280,000, which is the balance carried down you're seeing here. This balance carried down becomes balance brought down here, debit side 280,000. It means that wages account has a debit balance of 280,000. Now, after identifying the balances in the ledgers, we'll go ahead to prepare the trial balance. Your capital has what? A credit balance. So it means that your capital will appear in the credit side of the trial balance. Let's go trial balance now. This is the trial balance as at 31st March 2020. Capital here will come to the credit side, 2,150,000. Here we have purchases. The identified balance here, that's the balance brought down, is in the debit side, 804,000. It means that what? Purchases will appear in the debit side of the trial balance. So we have here purchases, 804,000. Let's go to the bank account here. It has another ledger here. The balance brought down is where? In the debit side. So bank will appear in the debit side of what? Of the trial balance. That's what you have here. Bank, 950,000. The next one, a cash account. The balance brought down is in the debit side. That's the debit balance. So your cash will appear in the debit side there, 1,090,000. So let's go. We have sales. Sales here has a credit balance. So it will appear in the credit side of the trial balance. We have sales here, 876,000. So we have Clinton. Clinton here, the balance brought down is where in the debit side. So has a debit balance. So Clinton is a debtor. It will appear in the debit side of the trial balance. Clinton debtor here, 356,000. Wages has a balance brought down in the debit side. So that means it has a debit balance. It will appear in the debit side of the trial balance. Wages here, we have 280 in the debit side. So we have Mrs. Caleb. The balance brought down is in the credit side. Caleb is a creditor here. So Caleb will appear in the credit side here. Mrs. Caleb, creditor 454,000. Now, after identifying the ledger balances and then putting them in their respective entries, whether debit or credit. Remember I said when the ledger balance has a debit balance, it comes to the debit side. If it has a credit balance, it comes to the credit side. So by virtue of our ledgers that we prepared from this transaction, capital has a credit balance, purchases has what? A debit balance, bank has a debit balance, cash has a debit balance, sales has a credit balance. Clinton has a debit balance. Wages has a debit balance. Caleb has a credit balance. So after extracting this balance, the test or the trial here is to what? Ensure that the total in the debit side is equal to the total in the what? Credit side. This is the test of the arithmetical accuracy of the ledger what? Balance. By the time we transfer all the balances in the ledger to the trial balance, it must agree. The debit total must agree with the what? Credit total. That is the test of the arithmetical accuracy. We just